Wilmar just posted a 13.5% profit surge in Q1 2025, slashed its debt by nearly 10%, and delivered $2 billion in cash from operations. But with a stock trading at just 0.73x book value, is this Southeast Asia food giant massively undervalued? Let's break it all down. Welcome to Durian Finance. And today, we're diving into Wilmar International's latest quarterly results, segment insights, financial strength, and investment potential. Disclaimer: this video is for educational and informational purposes only. It does not constitute financial advice. Please do your own research or consult a licensed advisor before investing. Wilmar is one of Asia's largest agribusiness groups, spanning oil palm plantations, edible oils, food products, sugar milling, and grains. It operates across more than 50 countries and processes over 80 million tons of agricultural products annually. With over $67 billion in annual revenue and a market cap of 18.5 billion Singapore dollars, Wilmar is not just big, it's globally strategic. In Q1 2025, Wilmar delivered solid results despite market volatility. Revenue rose 3.3% to $16.2 billion, while net profit surged 13.5% to $343.9 million. Core net profit was $343 million, up 4.4%. EBITDA jumped 19.3% to over $1 billion, reflecting strong operational performance. Free cash flow hit $1.77 billion, and net debt fell nearly 10% to $16.85 billion. This brought net gearing down to 0.83x, a healthier balance sheet. Overall, Wilmar showed resilience and financial strength heading into the rest of 2025. Wilmar's food product segment saw healthy growth, with consumer pack sales up 3.3% and medium bulk rising 2.2%, showing strong pricing power. In feed and industrial, tropical oils and grains grew 3.9% and 13.8% respectively, while sugar sales dropped over 40% due to seasonality. Plantation and sugar milling rebounded thanks to higher palm oil prices, and strong earnings from associates in China, India, and Southeast Asia continue to be a key profit driver. Wilmar trades at just 0.73x book value and 10.6 times forward earnings, making it one of the most undervalued blue chips on the SGX. Its PEG ratio of 1.22 and EV/EBIT of 8 suggests fair valuation for a company with global reach and stable earnings. The estimated 4.5% dividend yield adds to its appeal, though the debt-to-equity ratio of 128% means investors should watch leverage. Overall, Wilmar offers a compelling mix of value, scale, and steady income. Management expect the rest of 2025 to remain uncertain, especially with U.S. tariffs introducing volatility. But Wilmar's diversified model across upstream, midstream, and downstream helps cushion shocks. Risks include commodity price swings, trade tensions, regulatory shifts in key markets, sugar overcapacity and margin pressure in industrial feed. Still, Wilmar's wide footprint, especially in fast-growing Asia, gives it resilience. Over the last 5 years, Wilmar's revenue has held firm, staying around $67 billion since 2022. But net profit declined from $2.4 billion in 2021 to $1.17 billion in both 2023 and 2024, mostly due to shrinking margins and softer performance in industrial segments. Despite steady EBITDA above $4.2 billion, Wilmar's share price dropped from around 5 Singapore dollars and 30 cents in 2021 to 3 Singapore dollars by end 2024, reflecting investor concerns over profitability and debt levels. But things are turning. Q1 2025 shows signs of recovery, with net profit up 13.5%, EBITDA rising 19%, and net gearing improving to 0.83x. The share price now hovers around 2 Singapore dollars and 97 cents, suggesting possible bottoming out. If the next quarters continue this trend, Wilmar may be poised for a re-rating. Local analysts exhibit a generally bullish stance on Wilmar. DBS Bank maintains a buy recommendation, valuing the stock at 3 Singapore dollars and 80 cents, based on a fair PE assumption of 12 times. Maybank also upgrades the buy, with an optimistic target of 4 Singapore dollars and 5 cents. UOB High-End recently upgraded to buy at 3 Singapore dollars and 45 cents, while RHB stays neutral at 3 Singapore dollars. Other brokers like CGS-CMB previously initiated coverage with an ad and a target near 3 Singapore dollars and 94 cents. On average, the one-year target ranges between 3 Singapore dollars and 50 cents and 3 Singapore dollars and 80 cents, suggesting roughly 20% upside from today's price of 2 Singapore dollars and 97 cents. In summary, most analysts see value at current levels, leaning buy, with targets clustering between 3 Singapore dollars and 50 cents to 4 Singapore dollars, making Wilmar an attractive recovery play if earnings and cash flow continue to improve. If you're looking for a value stock in SGX with global exposure, strong cash flow, and defensive food-related business, Wilmar stands out. Its low valuation, improving cash position, and high dividend yield offer downside protection, while recovery in palm oil and China consumption could drive upside. Would you buy Wilmar at this level? Drop your comments below. And don't forget to like, subscribe, and hit the bell for more deep dives.